Welcome back to Talk Tickers. This is the Duck Dive.
Hey, everyone.
If you are out there trying to find the signal and the noise, or if you're hunting for that elusive alpha in the middle of earnings season chaos.
Which is pretty much all of us right now.
Right, exactly. Then you have found your tribe. We're the show for the buy side, the sell side, and frankly, everyone in between who knows that the headline number is, well, it's usually just a decoy.
It's the cover of the book.
Mm-hmm.
I mean, it might look nice on your terminal, but we all know the actual money is made in the footnotes.
It is entirely made in the footnotes. And today we are doing a deep dive into the Q4 2025 print from the pizza giant themselves, Domino's Pizza, ticker symbol DPZ.
The hungry for more quarter.
Yeah, we are definitely going to get into that tagline because honestly, when I first read it, it sounded like a marketing bumper sticker.
We'll get fluffy.
Very fluffy. But there is actually some serious hardcore strategy behind it. But first, let's just do a quick vibe check on the tape.
Let's do it.
We are recording this on February 23rd, 2026. The market is open, the numbers are out, and if you are looking at your screen right now, you are seeing a lot of green.
A lot of green.
The stock popped over 4% today, closed just a hair above $400, $400.36 to be exact.
Which, you have to remember, for a mature, relatively slow growth, quick service restaurant stock.
What we call QSR in the biz.
Right, QSR. For a QSR to make a move like that, it's massive. You usually only see those kinds of intraday rips in, like tech or small cap biotech. For a legacy pizza chain to jump 4% on a Monday, that is a huge signal.
It's a huge signal, but here is the kicker. And honestly, this is the entire reason we chose to do this deep dive for you today. If you just glanced at the headlines this morning, or, if you just follow the push notifications on your phone.
The standard financial news feeds.
Yeah, you would have seen a big red number. Their earnings per share, the absolute bottom line profit, actually came in below what Wall Street expected.
Right. They missed it by 2 pennies. Consensus was sitting at $5.37, and they delivered $5.35.
2 cents. And usually in this kind of macro environment where, let's face it, investors are jittery, rates are still relatively high, everyone's looking for an excuse to sell. If you miss the bottom line, the algos just decapitate you.
Oh, absolutely. Sell first, ask questions later.
Right. But that did not happen today. Today, the stock ripped. So my question to you right off the top, just to set the stage for everyone listening, why? Why did the market actively reward an earnings miss?
Because, simply put, the market stopped reading the headline and started reading the actual story.
Okay, unpack that.
It's a classic case of what we call quality over quantity. Yes, they missed the penny count on the bottom line, but when you strip away the noise and look at the actual engine of the business,
the core operations,
right, the revenue, the consumer demand, the unit economics at the store level, it was firing on cylinders that we frankly haven't seen in years. The market bought the narrative today, not just the spreadsheet. They bought the quality of growth.
Okay, quality of growth. Because usually, I have to be honest, when a CFO uses that phrase on an earnings call, it's code for, we missed our numbers, but please don't downgrade us.
Yeah, it's usually corporate spin.
But you're saying there is actual substance here. So let's break down the actual print, starting with the top line. Revenue came in at $1.4 billion.
Which was a beat.
It was. Consensus was looking for $1.52 billion. So they are up 6.4% year over year.
And that revenue beat is the foundation of the whole bull case today, because it tells you the organic demand is there. If you miss on earnings but you beat on revenue, it usually means you're just spending a little more money to get that growth, or you have some margin friction.
Which we will absolutely get to, because there is some nasty friction in the corporate margins.
Oh yeah, the insurance costs, we'll get there. But the point is, the demand, the actual human beings opening the app and buying the pizzas, that behavior is incredibly healthy.
And the definitive proof of that health is in the comps. Same-store sales. For anyone investing in retail or restaurants, this is the heartbeat of the stock. If you aren't growing same-store sales, your concept is dying.
Pure and simple.
So U.S. same-store sales were up 3.7%.
Which beat expectations.
Yeah.
The street was looking for about 3.5%. Now, I know 30 basis points might not sound like a huge deal if you're used to software margins, but in the restaurant game, that is a very solid beat.
Especially right now.
Exactly.
Yeah.
It shows that the U.S. consumer, despite all the doom and gloom, the inflation fatigue, everything, they are still showing up for Domino's.
Now, to be fair, the international side was a completely different story. International comps were only up 0.7%. That feels incredibly soft compared to the U.S. engine.
Soft is being generous. I mean, it missed the 1% expectation, which was already pretty low. We are going to have to spend some real time on that later because the international story is the absolute biggest drag on the stock right now. There's some serious drama going on with their master franchisee.
We will definitely get to the international drama, but before we leave this sort of high-level results snapshot, there is one more number that I think literally lit a fire under the stock today.
The capital return.
The capital returns. They hiked the dividend by 15% to $1.99 per quarter.
That is a massive, massive signal of confidence to the street. You have to understand how corporate boards of directors actually think. They are inherently conservative.
I hate cutting dividends.
It is the ultimate sin in corporate finance. You get fired for cutting the dividend. So a board will only hike a dividend, and especially by a double-digit percentage, like 15%, if they are absolutely unequivocally certain that the free cash flow is going to be there to support it, not just next quarter, but for years to come.
So you're saying this is a flex?
It's a huge flex. And look at their liquidity. The leverage ratio improved to 4.4 times.
Wow.
Yeah, they are actively delivering the balance sheet while simultaneously paying out more cash to shareholders. That is a very rare combination in QSR right now. It tells the street, hey, we are flush with cash and we aren't afraid to deploy it.
All right, let's transition into the meat of this deep dive because the street clearly looked past the penny miss on EPS. They completely looked past the international softness. They zoomed all the way in on the U.S. engine.
The domestic turnaround.
Right. And the phrase of the day, the phrase that CEO Russell Weiner just kept hammering on the call is hungry for more.
It's the name of the strategy, but he's really trying to make it the corporate mindset.
I have to be honest, when I first heard it, I rolled my eyes a bit. Hungry for more. It sounds like an ad agency pitched it. But then he dropped another phrase that I think we really need to deeply unpack for the listeners. He said, we have something better than pricing power. We have profit power.
I loved that line. I really did. It's catchy, sure, but the underlying unit economics behind it are fascinating.
Okay, but let's play devil's advocate here for a second. Profit power. Is that just a fancy Wall Street friendly way of saying we made money? Because the street loves a good buzzword. What does profit power actually mean in the day-to-day context of running a pizza franchise?
No, it's a distinct financial concept. To understand profit power, you have to understand pricing power first.
Okay, break it down.
Pricing power is simple. Inflation goes up, your cheese costs go up, your hourly labor goes up. So what do? You raise the price of your medium pepperoni pizza by $2. If the customer still buys it anyway, congratulations, you have pricing power.
Right, and that is exactly the inflation playbook we have seen for the last 3 or 4 years across the board. McDonald's does it, Chipotle does it, Wendy's does it.
Everyone does it. But there is a trap there.
The consumer breaking point.
Exactly. Eventually you find the ceiling. Eventually you raise the price so much that the average customer looks at the menu and says, you know what? I am not paying $18 for a fast food burger meal. And when that happens, your traffic falls off an absolute cliff.
Which is what we're seeing across casual dining right now.
Right. What Domino's did in Q4 was completely different. They achieved this profit power.
Give me the mechanics of that. How is it fundamentally different?
Okay, let's look at the U.S. comps again. Same-store sales were up 3.7%. But here is the absolute magic number, the real alpha, buried in the report. Pricing was flat.
Wait, flat? Like zero? They didn't take any price?
0.0. Pricing was completely flat in the quarter. That means the growth, that nearly 4% jump in sales, was driven entirely by transactions.
Order counts.
Order counts. Actual human beings ordering more pizzas more frequently, not just paying more money for the exact same pizza.
I mean, that is the holy grail in QSR right now, because almost everyone else we track has seen traffic decline, and they are masking it with higher tickets.
Precisely. Most of their competitors are actively hiking prices just to cover their own margin compression, which, as we just said, eventually kills the traffic. Domino's held the line. They held price flat, and they just aggressively stole market share. And this leads us directly to the profit power mechanic. Think about it from the perspective of the franchisee.
The guy or girl actually owning the physical store.
Right. You own a local Domino's.
Yeah.
You have fixed costs. You have to pay rent. You have insurance. You have the store manager's salary. You have to keep the lights on and the oven's hot.
A fixed nut.
The fixed nut. And those bills are the exact same whether you sell 100 pizzas that day or 1,000 pizzas.
Right.
So when corporate figures out a way to drive more volume through your specific store, more physical transactions, without forcing you to jack up prices and alienate your locals, you get massive operating leverage.
Because the baseline is already covered.
Exactly. Every single extra pizza you sell above your daily break-even point is pure high-margin profit. The rent is already paid for that day. The lights are already on. So that extra 10 or 15 bucks for the pizza flows almost entirely to your bottom line.
So by strategically keeping prices flat, they drove volume. By driving volume, they leveraged those fixed costs. And that created significantly more absolute profit dollars for the franchisee than a lazy price hike would have.
Bingo. That is profit power. You are making your franchisees richer by keeping their kitchen busy, not by gouging the end customer's wallet.
And we actually have a hard number on that franchise richness from the call, don't we?
You do. And honestly, this is the entire moat of the company. Estimated U.S. franchise EBITDA, that's earnings before interest, taxes, depreciation, and amortization, basically the cash profit, is now sitting at an estimated $166,000 per store.
Per store.
Per store. And that is up $4,000 year over year.
Okay, I want you to contextualize that for the listeners. Is 166 grand good for a franchise?
In this specific economy, where hourly labor costs are up, 20% over the last 3 years, with property insurance is skyrocketing. It's practically a miracle. Most restaurant franchisees across other brands are seeing their profits violently shrink right now. Domino's franchisees are seeing them grow.
And why does that specific metric matter so much to the stock valuation?
Because if I'm a franchisee and I'm clearing $166,000 in cash profit on a single box, I'm happy. And what do happy, cash-rich franchisees do?
They build more stores.
They build more stores. They happily remodel the old ones. They willingly invest in the new corporate tech initiatives. If your franchisee base is broke, the whole system collapses. They start cutting corners, service degrades, stores close. But if the franchisee is rich, the flywheel just spins faster and faster. That is why profit power is vastly superior to pricing power.
It creates a totally virtuous cycle. The franchisee makes good money, so they open another location. More stores means the delivery radius for each individual store gets smaller.
Which means faster delivery.
Right? Faster delivery times. Faster delivery times means significantly happier customers. Happier customers order pizza more often. The franchisee makes even more money.
It's the perfect feedback loop. And honestly, talking about the food itself, we shouldn't ignore the product. They lean heavily into the most delicious food pillar of their strategy with the New York-style pizza and that new Parmesan stuffed crust.
Right, I noticed that.
These aren't just marketing gimmicks. They actively drive ticket mix. Because even though baseline pricing was flat, your average check can still go up if people actively choose to buy premium, higher-margin products.
Yeah, you upsell them without raising the base price. But let's shift gears and talk about that pizza wars narrative, because usually these quarterly earnings calls are, frankly, very polite affairs.
Very scripted.
Right. Oh, the macro industry is challenging, or we deeply respect our competitors, blah, blah, blah. Not this time.
No. Russell Weiner basically chose violence today.
He really did. He came out aggressively swinging against this prevailing media narrative that pizza is dead. There has been this sort of ambient idea floating around Wall Street that people are just tired of pizza, or that the overall category is permanently shrinking because of GLP-1s or new health trends.
And he brought the receipts to disprove it. He stated flat out that the pizza category isn't shrinking at all. Historically, it grows about 1 to 2% a year reliably. It's a very mature category, sure, but it's remarkably stable. It is not going anywhere.
But then, and this was the moment of the call for me, he dropped the hammer. He explicitly mentioned a large national competitor. He didn't name them, but come on, we all know exactly who he's talking about.
Oh, yeah.
He noted they were closing 250 stores and posting negative mid-single-digit comps.
It's almost certainly Pizza Hut. Maybe a little bit of Papa John's in there, but mostly Pizza Hut, given the sheer scale of those closures. 250 stores is a massive, massive retreat.
And his point was just savage. He basically looked at the analysts and said, listen, their weakness is not an industry-wide category problem, it's a them problem.
It's a brilliant zero-sum game argument. He's telling the street, look, If the overall pizza category is organically growing 1%, but our main competitor is shrinking by 5% and boarding up hundreds of locations, where do you think those hungry customers are going?
They're coming straight to us.
Like
It's a total kill shot mentality. And frankly, as an analyst, it's really refreshing to hear a CEO be that blunt on a public call. He's essentially telling investors, do not punish our multiple for their operational incompetence.
And the unit growth numbers completely back up his swagger. You look at the net unit growth. Domino's opened 172 net new stores in the U.S. in 2025,
172.
while the other guy's closing 250. And here is the real stat that proves the underlying health of the Domino system. Closures. Do you know how many stores Domino's closed in the entire U.S. system for the whole year?
I have it right here. It was 7.
7. 7 single stores out of a base of over 7,000. That is a closure rate of practically absolute zero. Compare that directly to the competitor closing 250. That right there is the entire story of the U.S. pizza market. One system is profoundly healthy and expanding, the other is retracting and dying.
And this leads right into their most audacious goal. Management went on record stating they believe they can eventually double U.S. retail sales from current levels. Double.
I know, it sounds totally insane for a company that is already that ubiquitous. You drive down literally any commercial street in America, you see a Domino's. How on earth do you double that?
That's exactly what I wanted to ask you. Where does that sheer volume actually come from?
Well, they cited their own internal data. They have specific markets, certain towns or specific regions in the U.S. where they already command 40 to 50% total market share.
Wow, 50% of all pizzas sold.
Right. But nationally, on average, they are nowhere near 40 or 50% yet. So the management argument is very logical. We've already proven we can hit 50% share in Town A. Why can't we just replicate that playbook and hit 50% share nationally?
So it's fundamentally a penetration story, but it's also a fortressing story. I want you to explain that concept to everyone because it sounds incredibly controversial on its face. Splitting territories.
It is very controversial, especially when you first pitch it to the franchisees. Fortressing is the corporate strategy of purposely putting a brand new store right next to an existing successful store in order to split the delivery zone in half.
Which usually really pisses off the incumbent franchisee, right? Because they look at it and say, hey, you're stealing half my current customers.
Initially, yes, absolutely. It feels exactly like cannibalization. But the long-term data shows that when you split that territory, the delivery radius dramatically shrinks. So instead of a driver taking 20 minutes in traffic to get to a house on the edge of the zone, it takes 10 minutes.
So the pizza is noticeably hotter.
The pizza's hotter, the customer service is faster, and crucially for the unit economics, the driver can make significantly more runs per hour. So customer satisfaction jumps, and then order frequency goes up. Plus, and this is key, the carryout business explodes.
Why does carryout explode?
Because people will happily walk or do a quick 2-minute drive to a store that's just around the corner, but they absolutely will not walk to one that's 3 miles away across a busy highway. So eventually, the total pie gets much, much bigger for both stores. And since management noted that 80% of carryout sales are highly incremental, meaning those people were never going to order delivery anyway, the new store basically pays for itself without permanently killing the old one's margins.
That is fascinating. And speaking of carryout, we have to talk about their digital moat. Because carryout is now a $4.4 billion business line for Domino's.
It's massive. A business inside a business.
Yeah.
And it grew 6.5% just in Q4.
Why is carryout so highly strategic for them? Is it just because it's a growing revenue line, or is there a structural advantage?
Oh, it's entirely about the margin profile. Think deeply about the underlying economics of a single delivery order.
Okay.
You have to pay an hourly driver. You have to pay for commercial auto insurance. You have to reimburse them for gas and wear and tear. Even when you charge the customer a delivery fee, the net operating margin on that delivery is getting thinner every year. Now compare that to carryout.
Right. With carryout, you just make the pizza, put it in the box, and slide it onto the rack.
Exactly. The customer acts as their own delivery driver. They do the expensive last mile logistics for you for free. It's absolutely the highest margin transaction they can possibly process.
And it vastly expands the addressable market. I mean, I have friends who will flat out refuse to pay a $5 delivery fee plus a tip. They just hate the principle of it. But they will gladly pick up a hot $10 pizza on the way home from work.
Exactly. It perfectly captures that highly price-sensitive consumer who, in a tough economy, would otherwise just go to a McDonald's drive-thru or Taco Bell. And their loyalty program is really pouring gasoline on this. They reloaded the whole program in 2023, and they are now sitting at 37.3 million active users.
37 million, and that's up nearly 20% since the relaunch, right?
Yep. That is a staggeringly massive first-party database.
Yeah.
And when you own 37 million customer relationships directly, and you can just push a free notification to their phone on a slow Tuesday night saying, hey, Carryout Pizza is 50% off today only, you don't have to spend anywhere near as much on expensive national TV ads. It structurally reduces your customer acquisition cost.
We also really need to touch on the aggregators Uber Eats and DoorDash, because for the longest time, years really, Domino's stubbornly said, no, we will never use third-party delivery. We own our own logistics. They were very militant about it. Then they finally capitulated. Where do we actually stand there right now?
They are still very much in the ramp-up phase. Management explicitly said they are not at fair share on the aggregators yet.
Meaning what exactly?
Meaning if Domino's naturally commands, say, 20% of the overall U.S. pizza market, they should theoretically represent 20% of all the pizza orders placed on DoorDash. They aren't there yet. They're under-indexing.
So that represents a pretty clear tailwind for 2026.
A huge tailwind. As they get better at optimizing their digital marketing and placement on those specific platforms, they expect to grab a much larger slice of that third-party loyalist customer, the person who simply refuses to download the Domino's app and only orders whatever is on Uber Eats.
Okay, let's pivot to how they are executing all this so efficiently. We need to talk about the tech stack. Domino's has always positioned itself to Wall Street as a tech company that just happens to sell pizza.
Which, for a long time, used to be a bit of a marketing gimmick, but now it's undeniably true.
Right. They spent a lot of time on the call talking about this thing called the Orchestration engine. It sounds like something from a sci-fi movie or like a NASA launch protocol. What exactly is it, and why does it functionally make my pizza taste any better?
It's actually fascinating operational logic. Think about how it works at a standard, old-school pizza place.
Sure.
The order comes in by phone or web. The kitchen immediately makes the pizza. They bake it, pull it out of the oven, cut it, put it in a cardboard box, and then they just shove it on a metal rack under a heat lamp.
It just sits there.
And it sits there, waiting for a busy driver to finally get back from another run. Every single minute it sits under that lamp, the crust gets a little soggier, the cheese gets a little rubbery, the heat dissipates. The orchestration engine completely changes that sequence. It dynamically tracks the GPS location of every single driver in the fleet.
So the kitchen knows driver Bob is exactly 8 minutes away from returning to the store.
Right. And the algorithm also knows it takes exactly, say, 6 minutes to prep and bake a medium pepperoni pizza. So the system actually tells the kitchen line, do not make that pizza yet. It actively holds the order back in a digital queue. It waits until driver Bob is exactly 6 minutes and 30 seconds away. Then it fires the order to the make line screens.
Oh, wow. So the ultimate goal is for that specific pizza to come out of the oven, get boxed at the exact second the driver walks through the front door.
Zero dwell time. From the 450-degree oven, straight into the box, straight into the insulated bag, and out to your door.
That's wild. It's literally just-in-time manufacturing, but applied to pepperoni.
It is. And in a hyper-competitive game where the core product pizza is largely a commodity, your only real differentiators are price and quality. If my pizza consistently arrives hotter and crispier than the other guys purely because of an invisible algorithm, I win the market. That is the true digital moat. It's not just having a slick iPhone app. It's the deep operational logic tied to it.
Okay, we have been pretty aggressively bullish so far. We are definitely drinking the Kool-Aid, or I guess eating the marinara here.
Fair enough.
But as analysts, we have to honestly look at the bear case. Because it wasn't all sunshine and rainbows in this print. International was genuinely weak. Plus, 0.7% comps is nothing to brag about.
It's the Achilles heel of the stock right now. And the specific culprit is an entity called Domino's Pizza Enterprises, or DPE.
Which is a very confusing name, but that's the master franchisee, right?
Yeah.
Let's explain that corporate structure for listeners because it's critical to understanding the revenue flow.
Right. Domino's corporate dealer stock we are talking about today, DPZ, doesn't actually operate the physical stores in Australia or Japan or France. They essentially license the entire brand, the recipes, the tech, to a master franchisee. In this case, that's a completely separate, publicly traded company based in Australia called Domino's Pizza Enterprises.
So DPE basically just pays a percentage royalty back to DPZ in the U.S.
Correct. And DPE has been really struggling lately. They have had major execution issues. They significantly overbuilt store counts in some areas, and they completely misread the post-COVID consumer, especially in markets like Japan.
What happened in Japan?
Well, during strict COVID lockdowns in Japan, delivery obviously exploded. DPE looked at that data and mistakenly thought that was the permanent new normal. So they built aggressively. But when Japan fully reopened, the culture reverted. People went right back to eating out at local restaurants, and DPE was suddenly stuck with way too many delivery stores and not nearly enough orders to support them.
Ouch. Management did note on the call that DPE is currently in turnaround mode. They have a brand new CEO over there, Andrew Gregory.
Which is standard corporate code for this is going to take a minute to fix. The expert analysis here is that DPE is a significant drag on the global growth algorithm for DPZ. The hungry for more strategy is clearly working beautifully in the US, but the execution in these specific international markets has been incredibly sloppy. It's very much a show me story for 2026. Until DPE fundamentally fixes its own house, the international royalty numbers for DPZ are going to stay pretty muted.
Right. Now, the other big ouch factor in the report was the operating margins at the company-owned stores. They dropped down to 10.1%. That is down 5.4 full percentage points year over year. That is an absolute cliff dive. If I saw margins crash 540 basis points in almost any other business, I'd panic sell.
It is a nasty, nasty drop on paper. Management blamed outsized insurance costs and ongoing labor pressures. And to be fair, commercial auto insurance in the delivery business is skyrocketing everywhere. Accidents, liability, these massive nuclear verdicts in court. It's a very real systemic problem for the whole industry.
So why did the market completely ignore it today? If corporate margins crashed 500 basis points, why is the stock up 4%?
Because company-owned stores are an incredibly tiny fraction of the overall business model. Domino's is roughly 99% franchised. The corporate stores are basically just test labs for new tech and menus. Corporate owns maybe a few hundred, but their franchisees own many thousands. As long as the franchise margins, that 166 grand number we spent so much time on earlier, are holding up strong, the street will gladly forgive the corporate margin slip. Investors only really care about the high-margin royalty stream coming in, not the tight operating profit from the few dozen stores Domino's actually bothers to run themselves.
Got it. So the corporate margin hit is really just a noise factor, not a signal factor, as long as the broader franchise base remains healthy. Though I guess it does act as a sort of canary in the coal mine regarding those insurance costs.
Correct. It's absolutely something to keep an eye on. If insurance costs keep relentlessly rising, eventually that pressure hits the franchisees too. But for now, they are successfully offsetting that pain with sheer volume.
Let's look forward then. Let's get into the investor context. They gave us their official guidance for 2026.
They did. They are officially calling for U.S. comps of approximately 3%, global retail sales up 6%, and operating income growth of about 8%.
3% comps in 2026. Is that considered ambitious by the street?
It's solid. It's very consistent with their historical long-term algorithm. Management explicitly noted they expect the broader macro environment to remain pressured throughout 2026. They aren't wildly betting on a roaring stimulus-fueled economy. They're betting on a grind.
And that actually brings up the defensive nature of this stock, which I think is a huge part of why it popped today.
Absolutely. Domino's is the ultimate countercyclical asset in the restaurant space. Think about consumer behavior. When the economy is booming, people go out to nice steakhouses. They go to trendy, fast casual places where a custom salad lunch is $18.
Sure.
But when people start to feel broke, or when inflation really bites into their paychecks, they trade down. But here's the key. They don't stop eating prepared food entirely. Cooking every night is a lost art for a lot of busy families. So instead, they trade down from that $50 casual dining sit-down meal to the $20 Domino's meal that feeds the entire family.
It's the value refuge for the middle class.
Right. So if you are a portfolio manager and you are genuinely worried about a mild recession in 2026 or just a really slow, exhausted consumer, you hide your money in Domino's. The fact that the stock aggressively traded up today on a headline EPS miss tells you everything you need to know. Investors are currently willing to pay a premium multiple for certainty. They want guaranteed market share gains and defensive positioning over short-term, quarter-to-quarter earnings volatility.
And the buybacks certainly help provide a floor, too. They repurchased $80 million in stock in Q4 alone, and their remaining authorization is almost $500 million.
Combine that with the 15% dividend hike we talked about.
Yeah.
Look at the cash. They generated $671 million in free cash flow in fiscal 25. That is up 31% year over year. They are an absolute cash cannon. In a market where a lot of highly leveraged companies are sweating just trying to service their debt, Domino's is printing free cash and aggressively handing it back to shareholders.
So synthesizing all of this, what does this actually mean for you, the listener? We have a legacy company that is executing extremely well in a hostile, tough market. They are actively taking share from dying national competitors, and they are spitting out cash. But the international segment remains a massive question mark.
It's a textbook quality of growth story. The headline penny miss was algorithmic noise. The underlying comp growth and the franchise profitability are the true signal.
All right, I think we have analyzed this print to absolute death, but we cannot leave without doing our absolute favorite segment of the deep dive. It is time for not financial advice.
Ah, yes. The compliance department's least favorite 5 minutes of the week.
Exactly. This is the part of the show where we pitch an outrageous but entirely plausible trade idea based purely on the data we just discussed. Just a reminder to you listening, this is purely for entertainment. Do not trade on this. This is basically us role-playing as hedge fund pod analysts, brainstorming at 2 a.m. after 3 too many espressos.
Which, to be fair, happens way more often in real life than people think.
Too true. Okay, I'll go first. Pitch number 1. I am calling this trade the Pizza Fortress pair trade.
Right, let's hear it.
The core thesis is very simple. CEO Wiener explicitly mentioned a major competitor closing 250 stores and running deeply negative comps. We know the pizza space is a zero-sum game in a highly mature market. If they're permanently closing doors, DPZ is the one opening them.
So what's the actual mechanics of the trade?
You go long DPZ, and you simultaneously short the struggling national competitor. We're heavily implying it's Pizza Hut, which is owned by YM Brands, or maybe Papa John's. Let's just short YM Brands for the sake of the argument.
Okay, I like the basic structure, but let me play devil's advocate. If Domino's is so great, why not just go straight long DPZ? Why add the complexity and borrow costs of the short leg?
Because you are perfectly hedging out the commodity and macro risk. Think about it. Both of these companies buy massive amounts of wholesale cheese. Both companies buy wheat. Both companies have to hire thousands of delivery drivers in the same tight labor markets.
Yeah.
If global cheese prices suddenly skyrocket next month because of some supply chain shock, both stocks are going to get hurt. If you are just naked long DPZ, you lose money.
Right.
But if you are long DPZ and short the competitor, the cheese price shock hurts both equities equally, so the broader market movement essentially cancels itself out. You are purely 100% betting on execution divergence.
That is actually really smart. You are completely isolating the alpha. You are betting that Domino's successfully opening 175 stores, while the other guy boards up 250 stores, creates an inevitable spread in their respective valuations. It's what would you call it, a cannibalization arbitrage.
Cannibalization arbitrage. Oh,
Yeah.
I really like that. I am absolutely stealing that term.
That is actually remarkably sound logic for a wild pitch segment. You are stripping out the unpredictable macro environment and betting purely on the micro execution. I like it a lot.
Glad you approve. What have you got for us?
Okay, mine is a much broader macro play. I call it the GLP-1 insurance hedge.
Oh, here we go. The Ozempic trade. Literally every single fund manager on earth is trying to figure out how to model this right now.
Exactly. And management actually gave us a huge clue on the call. They stated explicitly that GLP-1s, these highly effective weight loss drugs, are noticeably impacting the breakfast and lunch day parts across the entire restaurant industry. People on these meds are just skipping that morning bagel or that heavy carb-loaded sandwich at noon. They physically aren't hungry. But, and this is the crucial part, management said it is not impacting the sharing occasion, which is dinner.
That is fascinating. So the working theory is, I essentially starve myself all day because the Ozempic suppresses my appetite, but then 6 p.m. rolls around, the family wants a hot dinner, so I cave.
Or even more likely, the logistics of a family still dictate the meal. You might personally be on Ozempic, but your 3 kids certainly aren't. And Friday night pizza is a deeply ingrained American ritual. It's cultural. It's not just about the calories. It's a communal social event. You order it for the house.
So what's the actual trade execution here?
You go long DPZ and you aggressively short fast casual lunch chains. Think about the expensive salad places, the boutique sandwich shops that heavily rely on the urban office lunch crowd. Let's say theoretically short Sweetgreen or short Potbelly.
I see. So you are fundamentally betting that the fancy $18 customized salad lunch gets absolutely killed by the appetite suppressants, but the $20 family pizza night remains culturally sticky.
Exactly. Plus, Domino's core value proposition physically protects it. If you are a middle-class consumer spending, $1,000 a month out of pocket on expensive weight loss drugs, your discretionary income is squeezed. Maybe you don't have $18 to drop on a fast casual salad every Tuesday, but you can always scrounge up $10 to feed the kids a pizza on Friday. It's a perfect financial hedge against both the changing American waistline and the shrinking American wallet.
I love it, the Ozempic paradox. Short the salad, long the pepperoni.
There you go. Print it.
All right, I think that is a perfect place to wrap this up. Let's do a quick recap for the listeners before we sign off.
Sure. DPZ Q4 was definitively a quality of growth print. The U.S. comps coming in at plus 3.7% were the absolute star of the show. Transaction growth, the actual order counts, is very real. Pricing was held completely flat, which is a massive operational flex in this environment.
And the franchise health is their ultimate insurance policy. $166,000 in average profit per store means the current doors stay open and new ones keep getting built. That is the physical moat.
Meanwhile, international remains the big show-me story for 2026. Keep a close eye on DPE in Australia and Japan. Watch the corporate insurance margins. But for right now, today, the U.S. engine is more than capable of carrying the load.
And what's your final provocative thought to leave them with?
The broader narrative you should take away from this isn't that Americans are suddenly eating more pizza in general. It's that they're very specifically eating Domino's pizza while their legacy competitors retreat and board up windows. In a flat, highly mature market, the apex predator actively taking market share is the only asset worth owning.
That right there is the alpha. Thanks for hanging out and listening to Talk Tickers. We will catch you on the next print.
Talk Tickers out.